In this video, we are going to talk about top 4 financial advice you really need to know. So before starting, please like this video and subscribe to this channel for our future updates. People have altered my financial plans over the past several years and devised a system to ensure that they are paying attention to my financial decisions on a daily basis. Because they do not come from a financial background, they have found themselves seeking guidance from a variety of places. They contacted friends and family for their finest recommendations, scoured blogs and websites for more information, and even reached out to a few highly recognized financial consultants for their most well-regarded advice. The amount of information I am consuming has left me feeling overwhelmed, which has caused me to wonder, what advice is worth putting aside and what advice is worth paying attention to? That's why I recently polled 4 different financial gurus about the most popular money advice they give their clients and which ones they recommend they ignore. Here are the top 4 financial advice you really need to know. So let's start. Number 4. Rigidly sticking to your plan with no flexibility. It is crucial to have a financial strategy in place, but there are occasions and you will need to adapt and adjust it. Your financial habits should be governed by strict discipline, but if your circumstances alter, your strategy may need to modify or evolve as well, depending on the circumstances. Consider the following scenario: you've lost your job or had your hours reduced. When it comes to reallocating cash, the creation of an emergency reserve should be the first and most important goal. Alternatively, suppose you have a child. It's possible that college funding may be added to the list of financial priorities. Plans are intended to be built on a solid basis upon which they can be built upon and evolved. If it's not something you require right away, give yourself a week to consider it. Is this purchase accompanied with a payment plan that will cause you to go over your budget? Will this have an impact on your savings? How would this help you in your day-to-day activities? Is the gain outweighed by the cost? Getting yourself into debt can be a vicious cycle that is difficult to break free from. You end up spending more money on interest than you would have had to if you had waited or saved more money. Putting anything off till the following week if you can't afford it is a good idea. If you want to go on vacation, make sure you plan ahead of time. Regularly saving will help you stay on track with your budget. Budgeting is about more than simply discipline. It is a tool to assist you in achieving your objectives, doing what you want to do, and living the life you want to live. Number 3. Claiming Social Security too early. In my mind, I don't often worry about Social Security and the age at which I'll be able to draw on that resource. Nevertheless, if you're concerned that the fund may go bankrupt, it is preferable to claim your Social Security payments as soon as you become eligible. In the event that the trust fund runs out of money, the vast majority of Social Security benefits will be covered by continued employer and employee payroll taxes. Claiming benefits too soon can result in a significant loss of benefits, with a 32% haircut or a potential loss of $1 million in payments over a long period of time. Applicants should instead wait until they reach the age of 70 in order to be eligible for a larger benefit amount if they are healthy and plan to live into their late 80s or beyond. Of course, cash flow is important as well, and a little forethought in terms of financial planning may go a long way. It is common for people to believe that once they retire, they will not spend nearly as much money as they did while they were working. However, even if some of your expenses decrease, you shouldn't expect to be able to live on half of your previous income or less, at least not unless you're making some substantial adjustments. It is difficult to pinpoint a certain Social Security filing age, because there are advantages and disadvantages to claiming benefits at various points in life. In some instances, filing for benefits prior to the FRA deadline is a good idea. When you file for Social Security benefits early, you are entitled to one do-over, but you can only use it if you do so before you have earned a full year's worth of benefits. If you began receiving benefits less than 12 months ago, you may be able to withdraw your application and it will be treated as if it never occurred. The catch, however, is that you will be required to refund in full all benefits that you have received. This includes not only the Social Security checks you received, but also any other benefits you received based on your employment history, such as spousal benefits, that were given to you. If you have been receiving benefits for the majority of the year, you may have to refund a significant quantity of money. Number 2. Keeping too much cash on hand. When I observe that the balance in my savings account is increasing, I consider whether I should keep the money in the account or transfer it somewhere else. The idea that cash is king is a common misperception among clients. Over the years, many people have come to the conclusion that having a large sum of money in cash is advantageous. However, in reality, this couldn't be further from the truth. With bank interest rates at rock-bottom levels and rising inflationary pressures on everyday goods and services, holding too much cash is more dangerous than ever in terms of putting you further away from your financial objectives. Instead, if you won't need your money for several years, consider placing it into the market, whether through a brokerage account, a retirement account, or another means. You can allow it to expand at a faster rate than inflation in this manner. Excess wealth can also put you in a position where you are more likely to make reckless decisions. Maintaining financial reserves indicates that you have reached a state of comfort with your business operation. Instead of proactively seeking out new growth ideas, you may find yourself in a reactionary state while making decisions. When you have a lot of cash on hand, it's simple to just throw money at difficulties like legal expenses, maintenance demands, and human resource requirements. While investments in these areas are frequently justified, executives who have a lot of wealth may be tempted to skip typical due diligence. Number 1. Choosing the wrong retirement plan. When it comes to devising a strategy for your financial future, a lot of people have different pieces of advice to offer. When it comes to your retirement plan, there is one widespread recommendation to avoid. Don't follow the advice that says that when you retire, you should take withdrawals from your taxable savings account until it is empty, then transfer the funds to your tax-advantaged accounts. When developing the ideal strategy, you'll want to ensure that you have the most effective withdrawal balance possible. This may entail taking withdrawals from your IRA now in order to reduce your future exposure to a higher tax bracket in the future, while remaining mindful of your current income and tax bracket thresholds. Create a plan that takes into account your expected lifespan, planned retirement age, retirement location, general health, and the lifestyle you want to lead before deciding on how much money to set aside. This will help you avoid sabotaging your retirement and running out of money. Your plan should be updated on a frequent basis as your needs and lifestyle change. Consult with a licensed financial planner to confirm that your plan is appropriate for your circumstances. If you cash out all or a portion of your retirement fund before reaching the age of 5,912, your plan sponsor will withhold 20% of the money to cover fines and taxes, resulting in you receiving less than the whole amount. You will lose future revenue because the majority of people never make up for lost time. In 2021, an average retired couple will require nearly $300,000 in savings to cover healthcare expenses in retirement, according to the Bureau of Labor Statistics. Maintaining good health will help you bring that number down. It's important to remember that Medicare does not cover all of your medical expenses in retirement. Plan to obtain extra insurance or be prepared to pay the difference out of pocket if the primary insurance is not sufficient. What do you think of our video? Let me know in the comments section below. If you enjoy this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.